investment managers who are managing the money of sophisticated investors who understand the risks associated with it. Again, that's not an insurmountable problem. They deal with illiquid markets all the time. This is a little bit unique in that I don't know if I know of another asset class where the published liquidity number deviates from the reality of the underlying liquidity as much. But again, that's their job. They're paid to understand that. So I think we have these issues in existing markets. Right? That we used to have, you have a notional number of options traded in certain commodity markets, but then when you look underlying, it wasn't actually a very broad or deep market. It was barreled or bar barreled with just a certain number of concentrated participants. So again, something they're used to dealing with. But again, I think the more that the exchanges come under regulatory scrutiny and have to shed light on actually what these volumes are, I think that certainly will get asset managers more comfortable to scale up more. They're just going to take the presumption that liquidity is a fraction of what it actually is and scale in accordingly, and that's just going to make it a low number.
I mean, I think you're seeing changes every day. About a year ago, we represented an investor who wanted to get his money out from an exchange. The underlying asset was thinly traded, and that's when we came in. It was not pretty. I don't think you're going to see the same extent of illiquidity with some of the larger names, but it is a concern, and I've seen that firsthand. But with the introduction of the futures markets, I think that by definition you will have an increase in liquidity, and I think that it will feed on itself. The more of the futures contracts that are trading, the more liquidity there will be.
That's actually a really, really good point. I think the more cooperation liquidity